So in this video, we're going to be talking about asset classes, and to help us understand the asset classes a little better, we're going to go through some slides. Great, so today we're going to be looking at asset classes, and as with all my videos, the slides themselves are available for download directly from my website, so there's no need to take notes. You can simply listen to what I'm saying and just absorb it, and you can go through them in more detail at a later stage. We've only really got 3 slides in asset classes. I'm trying to keep it nice and simple, so let's dive straight into it. An asset class is a grouping of investments that exhibit similar characteristics and are subject to the same laws and regulations. These are made up of instruments which often behave in the same manner in the marketplace. Depending on who you speak to, there are various opinions as to what constitute different asset classes. However, the most common are the equities, the commodities, real estate, cash, forex, and money market are all lumped together, fixed income, futures, and derivatives. On the next slide, I'm going to tell you a little bit more about each one of those 6 asset classes. But the reason investors need to understand the different asset classes has to do with the fact that different asset classes have different risk ratings. As such, they are used by investment professionals to balance the risk exposure to a client's investment portfolio. Basically, what we're saying there is if you want to get huge growth, you're going to pick a specific type of asset class, and your portfolio is going to be constructed in such a way as to skew itself for growth. On the other side of the scale, you could have people that are more cautious, and they're worried about losing their money in the markets, and so they want a much more defensive portfolio, and as a result, we would probably skew that more towards fixed income and cash. But we'll explain that as we go through the slides. So let's move on to the next slide and understand exactly what an equity is. So equity in the trading world refers to stock. In the accounting and corporate lending world, equity, or more commonly referred to as a shareholder's equity, refers to the amount of capital contributed by owners, or the difference between a company's total assets and its total liabilities. It sounds really complicated, but really what they're saying is that equity is a share in a company. So if you buy shares in Microsoft, or you buy shares in Amazon, or more closer to home, Anglo Gold, or Tongaat Hulett, or Tiger Brands, those are some big companies in South Africa, that would be considered holding equity. You are a shareholder in their company, and so essentially equity or shares in companies. The next asset class to consider is commodities. A commodity is a raw material or primary agricultural product that can be bought and sold, such as copper or coffee. Other things, you get corn, maize, soybeans, gold, silver, ferrochrome, all kinds of things fall into the commodities category. We'll talk more about that when we get down to futures. The next asset class to consider is real estate. Most people don't have any problem understanding real estate. There are 2 types of real estate that you get: commercial and residential. Obviously, the one has to do with business premises versus homes where people live. The next asset class, cash, is cash, forex, and money market accounts. Cash is basically cash in the bank. Most people understand that. Forex is the trading of different currencies in cash. And money market is short-term loans between banks and other financial institutions. So cash, as I said, has the lowest risk rating. It's basically in a bank account, and your biggest risk is if the bank decides to fold. But other than that, it's not invested in markets, and you can go to a bank 9 times out of 10 and withdraw your money whenever you want. It's very liquid. Forex is trading of currencies. So in South Africa, we have the rand. In the UK, there's the pound. And in the United States, there's the dollar. And so if you had to convert rands and buy dollars, that would be considered a foreign exchange transaction. And so we call that forex, a foreign exchange. We then have money markets. Money markets are usually where you would put money that you don't need right now, but you're going to need in a fairly short period of time, normally a period of months rather than years. And money market is a place where you kind of get a return. It's normally interest of around inflation, maybe 1 or 2% higher than inflation. And it's also a very conservative investment. It does have some exposure to markets and things, but normally less volatile investments and asset classes. Fixed income. Fixed income is an income from a pension or an investment that is set up at a particular figure that does not vary or is likely to vary and will rise with inflation. So some good examples of fixed income would be life or living annuities. That's one example of fixed income. And then when you get a little more technical, you can talk about government bonds, i.e. debt of governments, or even corporate bonds, which are, it's the debt of big companies. And generally what you do is, or when you take out a fixed income contract or you buy some kind of bond, you are being guaranteed for the loan of your money. Someone says, you're going to give me R1 million, and for that R1 million, I'm going to guarantee you that every year I'm going to give you 6%. Thank you very much for giving me your money. I'm going to give you 6%. And that's really, in very simple terms, how fixed income works. It's pretty much guaranteed, especially when it's government fixed income that you're buying or government bonds that you're buying. You would have to have the whole government and the whole country collapse in order not to receive that income or for them to default. So it's generally considered a low-risk investment. Futures and derivatives, these are a little more complex to understand, and we could spend a whole 2 hours going over the difference between futures and derivatives and how they work. But for the sake of this presentation, a future contract is a standardized legal agreement to buy or sell something at a predetermined price at a specified time in the future between parties not known to each other. The asset transacted is usually a commodity or financial instrument. So as an example, let's just say that I'm wanting to buy some wheat from the exchange. I go to the wheat exchange and I say, what is the current wheat price? I would like to buy wheat at the current price plus or minus, it depends. Say it's worth $100 at the moment, and you say, all right, I'll have a contract with somebody else who's happy to take up that contract on the other side, and I'll pay $105 for the same amount of wheat, but I will buy it in 2 months' time. I'll buy it in exactly 2 months' time, and then you have to deliver the wheat to me. Even if the wheat price is 107 Rand, I've bought it for 105 Rand. In that case, I've won. However, if the wheat price falls and it goes down to $99, I've agreed to pay him 105, so I have to pay him $105. So that's effectively, in very, very simple terms, how a future works. A derivative is also quite complex, but a derivative is a financial security with a value that is reliant upon or derived from an underlying asset or group of assets, which they call the benchmark. The derivative itself is a contract between two or more parties, and the derivatives derives its price from fluctuations in the underlying assets. Very, very, very difficult to explain, but in simple terms, you've got a basket of assets which people agree that very, very is similar in some respects to futures, but it's a contract where people agree on price of an underlying basket of assets at some point in the future, and they agree to pay price at some point in the future. Quite technical, and if you want to learn more about that, I suggest you watch another video that I'm going to put together on derivatives to explain a little bit more exactly how they work. And then we just need to understand that why are asset classes actually important? Understanding the different types of asset classes is important, as each behaves differently from the others in different economic market cycles. We call this behavior correlation, and having low levels of correlation between asset classes when constructing a portfolio is generally good. However, having said that, if you are looking for a growth portfolio, you want to make sure that you have a strong tilt towards equities and asset classes that give you a high return. So in that instance, you wouldn't want to have massive correlation differences. You would want to have a strong correlation, and correlation is normally measured between 1, 0, or -1. So a strong correlation would be a +1, and a strong negative correlation would be -1. So that would be the difference between the two. When we construct an investment portfolio, we try and diversify the portfolio in order to reduce risk, although in some instances we're not looking to do that, but generally you're looking to get the highest return for the least amount of risk. If one asset class is doing really badly, we need to make sure that the other asset classes are doing well. And the skill comes in trying to have more good asset classes than bad ones to ensure you maximize your returns. It's fairly simple to understand. So that graphic that I've got in the slide is sometimes called the Smarty Box, and it shows how different investments or asset classes have performed over time. Historically, equity has been the best performing asset class, whether local or foreign equity. They have far outperformed any other group. However, they are also the most risky and volatile, as I've mentioned earlier. The worst performing asset class, unsurprisingly, is cash. Having money in the bank or under the mattress means it is not growing. And as we know, every single year we have inflation, and if we're not keeping up with inflation, we're actually becoming poorer or worse off. In a nutshell, that's asset classes. I hope you enjoyed the video. Remember, please, to like and share it if you found this interesting. Thanks very much for watching.